Hi students. So in the previous class we discussed what is meant by bookkeeping and types of the bookkeeping and the differences between bookkeeping and accounting. So general bookkeeping is nothing but the process of recording the transactions and events in a systematic manner, and it covers what recording, classification and the preparation of the trial balance. Those three are covered in the definition of the bookkeeping. And we discussed what are the objectives. The objective of bookkeeping is nothing but what? Recording of the transactions and events in a systematic manner and ascertaining the effect of the similar nature of the transactions on the position of the entity. Then, bookkeeping is done generally in two ways. One is single entry system, another one is the double entry system. And single entry system, we used it for accounting for incomplete records, and double entry system is used for complete records. As per double entry system, every transaction is having what two aspects. One is the receiving aspect, another one is giving aspect, and those are also called as debit aspect and credit aspect. And this is framed based on what dual aspect concept and is invented by Luca F. Pacioli. And for knowing that, for identify the respective receiving and giving aspect, or debit and credit aspect, we have the two approaches. One is the traditional approach, another one is modern approach. As per traditional approach, all accounts are classified into three types: personal account, real account, and nominal account. And these are the rules of the traditional approach. In coming to the personal account, debit the receiver, credit the giver. Coming to the real account, debit what comes in, credit what goes out. Coming to the nominal account, debit all expenses and losses, credit all incomes and gains. Coming to the next one, accounting equation approach. So as per this, accounting equation is defined as what capital plus liability plus income is equal to what assets plus expenses. So based on this, all accounts are classified into the five types. One is capital and liabilities, income, assets and expenses. And you may write the net accounting equation by simplifying that equation as capital plus liability equal to asset. As so because income minus expense represents what profit or loss, which is ultimately transferred to the capital. Okay, net accounting equation is capital plus liability equal to asset and is also called as balance sheet equation as it is in the form of the balance sheet. And coming to the rules. So capital rule is increase in capital is credited, decrease in capital is debited. An increase in liability is credited, decrease in liability is debited. Increase in income is credited, decrease in income is debited. An increase in asset is debited, decrease in asset is credited. An increase in expenses is debited, and a decrease in expenses is credited. And already we discussed how to analyze the transactions also. And in this session also, I will tell you how to analyze the transaction and at the same time how to frame the accounting equation for the given transaction. So, okay, for example, frame the following transactions. In the form of capital plus liability equal to asset. For example, Mr. Abhi started a business with cash rupees 5 lakh. Goods purchased from the Mr. Bhargav, rupees 3 lakh. Amount paid to the Mr. Bhargav, 1,50,000. Salaries paid to the employees, 50,000. Sale of goods worth rupees 1 lakh for rupees 2 lakh 50,000. And the last one, rent for the year 50,000, but we paid 20,000. This is the problem. We have to frame these all transactions in the form of what capital plus liabilities is equal to 6. Okay. So first, coming to the first transaction. So Mr. Abhi started business, and it means he bring the amount into the business. So due to that, the cash balance is increases. Cash is an asset, so asset is increased by rupees 5. And amount brought by the owner is a technically called as what capital. So as he bring the amount into the business, and the amount payable to him is increased. So capital balance increases, and the liabilities is not affected. So that accounting equation is 5 lakh. 5 lakh plus 0 equal to 5 lakh. And next one, goods purchased from Mr. Bhargav. So here, this is a credit transaction because only the name of the person is mentioned, but nowhere we have the word for cash. So it is a credit transaction. So first we purchase the goods, nothing but we receive the goods. Good is for nothing but what asset. As the goods increases, the total asset balance increases, and is increased by how much amount? 3 lakh. And that amount is not paid to the party immediately. So the amount payable to the supplier increases. Amount payable to the supplier is nothing but what? A liability. So liability is increased by 3 lakh, and the capital is not affected. So net accounting equation is 0 plus 3 lakh equal to 3 lakh. Next, amount paid to Mr. Bhargav. And if you have any transaction like amount paid to Bhargav or amount received from Mr. Bhargav, then you need to check whether that party is a debtor or creditor. Nothing but whether the party is a supplier or whether the party is a customer. If the party is a supplier, nothing but creditor, and that is a liability to us, and if the party is a customer, and that is he is a debtor to us. So as we pay the amount to the Bhargav, and because previously we purchased the goods from Mr. Bhargav rupees 3 lakhs, so amount payable to that party is reduced to the extent of amount of paid. So how much amount we paid is there? 1,50,000. So 1,50,000 reduced liabilities. And at the same time, we paid what? Cash. So cash balance is decreased by 1,50,000. So automatically cash balancing decreases means asset decreased by 1,50,000. And the liability capital is not affected. So net accounting equation is 0 minus 1,50,000 equal to minus 1,50,000. Next, salaries paid to the employees. So rupees 50,000. Salaries paid. As we discussed previously, so expenses leads to what? Losses, and losses decreases the capital, and income so generates what? Profit. It increases the capital. It increases the capital. So here salary paid is a nothing but what? That is a expense. So as we pay the expense, the cash goes out of the business. So cash balance is decreased by rupees 50,000. So asset is decreased by 50,000. And another one, it is an expense. It is a expense. So nothing but it is a loss, and loss leads to what? Decrease in capital. So capital is a decreased by 50,000, and the liability equal to 0. Minus 50 plus 0 is equal to minus 50,000. And next, sale of goods. Sale of goods worth 1 lakh rupee for 2 lakh 50,000. And we sold it for 2 lakh 50,000. And remember, first, whether it is a cash transaction or credit transaction, that is a cash transaction because no person name is mentioned there. So we received cash of rupees 2 lakh 50,000. As the cash received, the cash balance increases and the asset is increased by, so asset is increased by 2 lakh 50,000. Asset is increased by 2 lakh 50,000. And in return, we provide the goods to the party. And it means if you sell the goods, so only goods worth of rupee 1 lakh goes from the business to the outsider, nothing but to the customer. Only 1 lakh worth of the good is nothing but what? Asset. As the as the goods goes out, the goods balance is a decrease and it means asset balance a decrease. Asset is a decreased by 1 lakh. Asset is a decreased by 1 lakh. And we purchase 1 lakh worth of the goods are sold for rupee 2 lakh 50,000. Means we have the profit of how much amount? 1 lakh 50,000. Profit or loss, if any, is transferred to capital. Profit leads to increase in capital, but loss leads to decrease in capital. So here we have the profit of 1 lakh 50,000. So capital is increased by 1 lakh 50,000 and the liability is not affected. So net accounting equation is, so 1 lakh 50,000 plus 0 is equal to 1 lakh 50,000. Okay, I hope you understood. So here 2 lakh 50, sell the goods worth 1 lakh for 2 lakh 50,000. So we receive the cash of 2 lakh 50,000. To that extent, cash balance increases means is increases and the goods goes out. Only 1 lakh worth of the goods goes out of the business. So asset balance is decreased by 1 lakh. And the net impact 1 lakh worth of the goods sold for 2 lakh 50,000 means we have a profit of rupee 1 lakh 50,000. Our profit or loss, if any, we transfer to capital. So capital is increased by 1 lakh 50,000. So net accounting equation is 1 lakh 50,000 plus 0 equal to 2 lakh 50 minus 1 lakh. Okay. And next one, rent for the year 50,000. Actually, rent is nothing but what? Expense. So already we utilize the total building for 1 year. 1 year. For that, we liable to pay 50,000 to the owner. We as we receive these services, that expense was incurred. That expense was already incurred. So expense leads to what? Losses, and the losses leads to decrease in capital. So capital is decreased by 50,000. Okay, but out of that, how much amount you paid to the landlord? 20,000 only. So means the cash goes out only to the extent of 20,000, not the 50,000. So cash balance is decreased by 20. Nothing but asset is decreased by 20,000. And the remaining amount of actually we liable to pay 50,000, but we paid only 20,000. And the remaining 30,000 we liable to pay in future. Whatever the amount we liable to pay in future, nothing but that is an obligation that's covered under liabilities. So liabilities is increased by how much amount we liable to pay? 30,000. So minus 50 plus 30 equal to minus 20,000. And this is the framing process of framing the accounting equation. Okay. So we'll calculate. So here 4 lakh 50,000, 1 lakh 80. So This is the total net accounting equation. 4 lakh 50 plus 1 lakh 80 equal to 6 lakh 30,000. 6 lakh 30,000. This is the process of framing the accounting equation. Okay. I hope you understood. This is the accounting equation method. Okay. And next. So next coming to entry. And as we already discussed how to analyze the transaction and the event. Okay. So before going to the in-depth analysis of the analyzing of transactions, first we have to know how to write the transaction. The process of recording the transaction in the books of accounts is called as entry. So how we write the entry? So as we discussed, so in case of double entry system, every transaction is having what two aspects. One is the receiving aspect and another one is a giving aspect. And for identifying that receiving and giving aspect, nothing but debit and credit aspect, two approaches are there. One is the traditional approach and another one is the modern approach. So, after identifying that debit and the credit aspect, how to present the transaction in the books of account. The process of presenting the transaction in the books of account. Presenting the transaction in the books of accounts is called as what? Entry. Is called as what? Entry. So entry is nothing but it is the combination of both debit aspect and the credit aspect by using the words DR and to. Entry is nothing but it is a combination of both the debit aspect and the credit aspect by using the words DR and to. So first we have to write the debit aspect. And the debit aspect ends with the word DR. And from the middle of the debit aspect in the next line, we have to start the credit aspect. And the credit aspect starts with the word to. So this is the format of the entry. So entry is in the process of presenting the transaction in the books of account is called as entry. Or simply said, you may consider it as the process of noting the transaction in the journal is called as what? Entry. But entry consisting of two aspects. One is the debit aspect and credit aspects, and the both are combined together by using the words DR and to. We have to write the entry in this format. First, we have to write the debit aspect, and the debit aspect ends with the word DR. And from the middle of the debit aspect, in the next line, we have to start the credit aspect, and the credit aspect starts with the word to. So DR and to is we have to read those two words as a debited to. Debited to. For example, salary is paid to the employees 50,000. Here the receiving aspect is nothing but what? Service. And the service is represented with salaries account. And the salaries account is a expense. And expense is a nominal account. And as per nominal account rule, all expenses and losses are debited and all incomes and gains are credited. As it is an expense, that account is debited. And coming to the giving aspect, we pay the what cash account. Cash is a real account. Cash is a real account. As per real account, what is the rule? What comes in is debited and what goes out is credited. Here, cash goes out. So those are credited. So then after completion of the analysis, we have to write the transaction in the form of entry. First, we have to write the debit aspect. What is the debit aspect here? Salaries account. Credit aspect is nothing but cash account. We have to write first debit aspect. We have to write salaries account and is ends with the word DR. From the middle of the credit debit aspect, we have to start the credit aspect in the next line and is always starts with the word to cash account. This is the form of entry. And we have to read it as salaries account debited to cash account. Salaries account debited to cash account. Okay. So this is what is meant by entry and how to write the entry. Okay. Next. So next one, analysis of the transactions. And in this stage, we discussed the analysis and the framing of the entry also. Okay. And first, we discuss. So transactions relating to the owner. Transactions relating to the owner. And before going to that, so just remember one concept. So once the business is started by the any person, once the business started by any person, the owner is treated as a separate entity. Owner is treated as a outsider. So once the business started, owner is separated from the business, and every transaction should be think from the point of view of the business owner. Every transaction. So nothing but if the amount brought by the owner into the business, we have to consider it as just like an amount borrowed from the outsider, just like amount borrowed from the outsider. So that concept is called as what business entity concept. What the business entity concept says, owner is always separated from the business, and accountant should record the transactions from the point of view of, sorry, from the point of view of business only, from the point of view of business only. So based on that, amount brought by the owner into the business is treated as amount payable to the owner. Amount payable to the owner after certain period. So that is considered as a liability. But owner is always have significancy. Owner is always have some respect. So amount payable to the owner is represented with a separate word called as capital, called as what? Capital. So as we discussed two things, one is capital, another one is drawings. If any amount brought by the owner into the business is called as capital, and any amount withdrawn by the owner for his personal purpose is called as what? Drawings. It's called as what? Drawings. So, and those are required to be mentioned separately as per which concept? Business entity concept. Capital is shown on liability side, and only because of this concept. And the drawing is having the debit balance, and is also done as per this concept only, nothing but business entity concept. Okay, so as and when the amount of introduced by the owner, we have to use the word what capital, and as and when the amount withdraw by owner for his personal purpose, we have to use the word drawings. Okay, so in first one, for example, Mr. Abhi started business with cash, rupees 5 lakhs. Then, what is the receiving aspect and giving aspect? The receiving aspect, there is no receiving, sorry, we received what? Cash. We have to think from the point of your business only. So, cash. Cash is a real account. And what is the rule for real account? Debit what comes in, credit what goes out. Here, cash comes into the business, so that account is a debited. And what is the giving aspect? So there is no giving aspect by the business to the outsider or to the owner. There is no giving aspect. And remember, instead of giving aspect, if the giving aspect is missed in the transaction, then think about who is the giver. If the receiving aspect missed in the transaction, then think about who is the receiver. And here there is no giving aspect. Then who is the giver? Who is the giver? Nothing but owner. So amount brought by the owner into the business is represented with the letter with the word capital account. Capital is a personal account. As the personal account rule, debit the receiver, credit the giver. Here owner is the giver, so that account is a creditor. Owner is the giver and his account is a creditor. So what is the journal entry to be recorded? So cash account debited to capital account. Cash account debited to capital account. Okay. So here amount brought by the owner into the business. Then receiving aspect is nothing but what? Cash. Cash account is a real account. So real account rule is debit what comes in, credit what goes out. Here cash comes into the business, so that account is debited. And there is no giving aspect. So if the giving aspect is a miss, and if there is no giving aspect, then think about who is the giver. Same way, there is no receiving aspect, then think about who is the receiver. So in this transaction, no giving aspect is there. Then who is the giver? Owner. Owner is represented with the word capital account. So capital account is a personal account. And as per the rule of personal account, receiver account is debited, giver account is credited. Here owner is the giver, so his account is credited. Okay. So entry is cash account debited to capital account. Next. Amount withdraw by owner for his personal purpose or domestic purpose or household purpose. So if we have these words, then we have to consider it as what? Drawings. And remember, any amount withdraw by the owner for official purpose or for business purpose, remember it is not the drawings. It is not the drawings. Okay. So then what is the receiving aspect and giving aspect is there? Is there any receiving aspect by the business? Remember, you have to think from the point of view of business only, not from the point of view of owner. So what is the receiving aspect there? There is no receiving aspect. Nothing was received by the business. So instead of, if the receiving aspect is missed, then you have to think about who is the receiver. Who is the receiver? Their owner. And owner is represented with the word. So amount withdraw by the owner for his personal purpose. If any amount withdraw by the owner for personal purpose, we have to use the word drawings account. Drawings is a personal account. As per the rule of personal account, debit the receiver, credit the giver. Here owner is a receiver His account is a debited. Owner is a receiver and his account is a debited. And what is the giving aspect there? We pay the what? Cash. So cash is a real account. And what is the rule for real account? What comes in is a debited and what goes out is a credited. So cash comes into the business. So cash goes out of the business. So that account is a credited. So what is the journal entry? Drawings account debited to cash account. What is the journal entry? Drawings account debited to cash account. So that is a transaction. If the amount withdrawn by owner for his personal withdrawn by owner for his personal purpose, and we consider it as a drawing, and the journal entry is drawings account debited to cash account. And the amount brought by the owner into the business is called as capital. We write the journal entry cash account debited to capital account. Okay. And next, for example, Mr. Abhi started business with cash 5 lakhs, plant and machinery 10 lakhs, land and building 8 lakhs. He brought three items into the business at a time. He brought three items into the business at a time. And remember, so before that, entries generally of classified into the two types. One is single entry, sorry, simple entry and compound entry. Simple entry is nothing but entry consisting of only one debit and one credit. Entry consisting of only one debit and one credit. So, for example, in this scenario, we have what receiving aspect. And the receiving aspect, we have three items. Three items are there. So we received what? Cash account and plant and machinery account, land and building account. And here the receiving aspect is nothing but cash account is a real account. And what is the rule for real account? What comes in is debited, what goes out is credited. So it comes into the business, so that is a debited. And plant and machinery is an asset, so it is a real account. Tangible asset, it is a real account. And it also comes into the business because that is brought by owner into the business, so that account is a debited. And land and building is also a tangible asset, so that is also a real account. So comes in is a debited. Comes in is debited. And giving aspect, there is no giving aspect. In the absence of the giving aspect, we have to think about who is the giver. Here, who is the giver? Owner. Owner is represented with the word capital. Capital is a personal account. What is the rule for personal account? Debit the receiver, credit the giver. So here, owner is the giver. So his account is credited. His account is credited. So then you can write this transaction separately as amount brought by the owner with in cash, and plant and machinery brought by the owner into the business, land and building brought by the owner into the business. So we can write the entry in this way. So nothing but cash account debited to capital account. How much amount? 5 lakhs. And another one, plant and machinery account debited to capital account 10 lakh, and land and building account debited to capital account 5 lakh. You may write the transaction separately for every item. For cash brought by the owner is recorded as cash account debited to capital account, and the plant and machinery brought by the owner into the business, we write it as plant and machinery account debited to capital account. Land and building brought by the owner into the business, we recorded it as land and building account debited to capital account. And we write the entry separately for every item brought by the owner. And here, if you observe, in every entry, we have only one debit aspect and one credit aspect. If the entry consisting of only one debit and only one credit, and that entry is called as what? Single entry, simple entry. That is called as what? Simple entry. We call it as simple entry. But remember, if these all transactions are happened on the same date, relating to a particular item like capital, then instead of writing separate entry for every aspect, you may write a single entry by combining all these aspects. By combining all these aspects, then we can write the entry what? So cash account debited 5 lakhs, plant and machinery account debited 10 lakh, land and building account debited 8 lakh, to capital account how much amount? 23 lakh. And here, if you remember, if you verify, here the entry consisting of more than one debit aspect. So if the entry consisting of more than one debit or more than one credit, that entry is called as compound entry. That entry is called as what? Compound entry, or you may consider it as combined entry. You may consider it as what? Combined entry. Okay, so you may write separate entry for every aspect, like cash brought by the owner into the business, plant and machinery brought by the owner into the business, and the land and building brought by the owner into the business separately. Or instead of that, you may write single entry. But remember, the compound entry is possible only if these all aspects, all transactions are done on the same date, and those are relating to a single item. Nothing but here, all are relating to what? Capital. And the three items brought by the owner on the same date. So we can combine cash account debited, plant and machinery account debited, land and building account debited to capital account. So instead of writing separate entry for every aspect, you write what? Single entry. You write what? Single entry. So this is nothing but so simple entry and compound entry. So entries are classified into the two types. One is a simple entry and another one is a compound entry. So simple entry is nothing but the entry consisting of only one debit and only one credit, called as simple entry. Compound entry is nothing but entry consisting of more than one debit or more than one credit, is called as what? Compound entry. Okay, so these are the transactions relating to the owner. So amount brought by the owner into the business, entry is cash account debited to capital account, and amount withdrawn by the owner for his personal purpose. Remember, if any amount withdrawn for his personal purpose or domestic purpose or household purpose, only we can write it as a drawings, and then we can write drawings account debited to cash account. If the amount withdrawn by the owner for the official purpose, and we cannot consider it as a drawings, just like we have to write the entry cash withdraw from official purpose. And so entries are classified into the two types. So one is a simple entry, another one is compound entry. Simple entry is nothing but if the entry consisting of only one debit and only one credit, called as simple entry. The entry consisting of more than one debit or more than one credit is called as what? Compound entry. So this is about the transactions relating to the owner. Transactions relating to the owner. And the remaining will be discussed in the next class. Thank you.